It's the evening of January 15th, 2026. The markets are closed. The noise has quieted. But if you're watching the metals right now, you can feel it. That thick, heavy air before something breaks. I'm a private commodities analyst. I've been stacking physical silver and trading these markets for 12 years. I built this channel because I got tired of waiting half a day for mainstream media to report what I was already seeing in real time on my Bloomberg terminal. And frankly, I got tired of watching all these AI avatar channels pump out fake news and recycled hype about silver. So, I use this avatar for one reason: speed. I can get you the real information faster than anyone else. No fluff, no theatrics, just the data. Tonight, I need to walk you through something that's happening right now. Something the financial media won't want to touch with a 10FT poll because it exposes a mechanism they don't want you to understand. Here's the hook. Silver got hammered this morning at 9:45 a.m. Eastern. We saw a brutal 4% dump. The kind of move that triggers stop losses, that shakes out weak hands, that makes retail traders panic, sell and swear off metals forever. And the mainstream narrative, they're calling it a natural cooling period for a stretched sector. They want you to believe this was just retail investors losing their nerve, that the silver bull is tired, that maybe it has time to rotate back into tech or bonds or whatever they're repumping this week. But here's what they're not telling you. The screen is lying. Because while silver bled 4% at the open, the miners, the actual companies that dig this metal out of the ground, barely flinched. The silver miners ETF ticker only opened down 1.4%, and by midday it had recovered almost all of that. Let me say that again. Silver dropped 4%. The miners dropped 1.4%. That's not weakness. That's relative strength. That's the first signal of a major trend reversal. That's the market telling you something is very, very wrong with the official story. And here's why this matters. Right now, tonight as you're watching this, we are less than 12 hours away from January 16th, third Friday of the month. Monthly options expiration OPEX. For those of you who've been in these markets long enough, you know what that means. It's the most dangerous day of the quarter for institutional short sellers. It's the day where billions of dollars in derivative positions either print money or explode in their faces, and there's a reason the miners aren't moving yet. It's not because they're weak. It's because they're being held underwater by a very specific, very expensive anchor. Let me tell you what I think is really happening here. Silver miners are being artificially suppressed to protect massive bank short positions ahead of tomorrow's monthly options expiration. That's the thesis. That's what I'm going to prove to you over the next few minutes using hard data, basic math, and a mechanism that most retail investors don't even know exists. Here's the conflict. Silver is trading near $91, but mining equities, the stocks of the companies actually producing this metal, are priced as if we were still in a $30 environment. This isn't just a lag. This isn't the market being slow to react. This is a structural anomaly that shouldn't exist under any rational pricing model. And here's my promise to you. I'm going to break down the operating leverage trap. I'm going to run the hard math on why these stocks are spring-loaded, and I'm going to reveal my personal battle plan for the volatility I am expecting in the next 24 hours. Because here's the thing. In 2025, silver rose 140%, one of the best performing assets in the world. And the miners, they're only just starting to wake up. The great catch-up isn't a theory. It's a mathematical certainty. And I believe it begins tomorrow. So, let's get into it. A few hours ago, I was looking at my screens. It was 11:45 a.m. Eastern. Gold was sitting at $46,859, down 0.13%. Silver was at $91.52, down 0.75%. Not dramatic moves, just the usual chop. But if you weren't watching the intraday tape, you missed the real story. At 9:45 this morning, silver got absolutely destroyed. We're talking a 4% flush in a matter of minutes. The kind of move that looks like capitulation, that smells like blood in the water. This wasn't random, this was a stop-loss raid. This was designed to trigger a cascade. You drop the price fast enough, hard enough, and all those retail stops sitting just below support get hit. Then those forced sells trigger more sells. Momentum algorithms pile on, and before you know it, you've got a self-reinforcing panic spiral. That's the playbook. That's how you shake out weak hands and accumulate a position at lower prices. But here's where it gets interesting. While silver was down 4%, silver miners only opened down 1.4%. 4%. And then within an hour it started to recover. By the time I checked at 11:45, the miners were showing serious relative strength. If you've traded equities long enough, you know what relative strength means. It means the sector is decoupling from the underlying commodity. It means someone is defending a floor. It means the smart money is stepping in while everyone else is panicking. And when I pulled up the chart of that 945 recovery, I saw a perfect V-shaped bounce that is not retail buying. Retail doesn't move that fast. Retail doesn't have that kind of coordinated firepower. That's institutional. That's the floor being defended. And it made me ask the obvious question. Why would someone fight so hard to keep silver below $92? The answer is a single financial mechanism that's about to explode. And to understand it, you need to understand operating leverage. Let me teach you this concept because it's the key to everything. Operating leverage is the magnifying glass of profitability. It's what happens when the price of what you sell explodes, but your costs stay relatively fixed. Here's the simplest way I can explain it. Imagine you run a lemonade stand. It costs you $1 in lemons and sugar to make a cup of lemonade. You sell it for $110. Your profit is 10 cents per cup. Now imagine there's a heat wave. Suddenly, people are desperate for lemonade. The price jumps to $10 a cup, but your cost's still $1. Lemons didn't get 10 times more expensive. Sugar didn't get 10 times more expensive. Your costs are sticky. They're slow to adjust. So now your profit isn't 10 cents. It's $9. That is a 9,000% increase in profit from a 900% increase in price. That's operating leverage. And that's exactly what's happening with silver miners right now. These companies have all-in sustaining costs, AISC for short, of around $30 per ounce. That's what it costs them to pull silver out of the ground, refine it, and bring it to market. That number includes everything: labor, diesel, machinery, permits, taxes, to works. When silver was trading at $35, the profit margin was razor thin. You're talking about a 14% margin. These companies were surviving, not thriving. But now, silver is at $91. Let me show you the math. The formula for profit margin is simple. Profit margin equals price minus all-in sustaining cost divided by price. So, at $35 silver with $30 AISC, the margin is $5 divided by $35, which equals 14%. But at $90 silver with $30 AISC, the margin is $60 divided by $90, which equals 67%. The profitability didn't just double, it didn't triple, it increased by a factor of almost 5. And yet the stock price is flat, dead, pinned to the mat. That's the trap. That's the anomaly. That's I am sitting here tonight telling you that silver miners are the most undervalued sector in the entire macro landscape. Now, before you think I'm just some permeable pumping opium, let me address the skeptics because there are legitimate counter-arguments here and I want to steal them in them. Skeptic argument. Number 1. AISC is rising too fast. The bears will tell you that inflation in diesel, labor and machinery is eating all the profit, that these miners aren't actually making money because their costs have exploded along with the silver price. Here's my rebuttal. Yes, costs have risen. Diesel is more expensive than it was 3 years ago. Labor costs have gone up. Equipment prices have increased, but they haven't tripled. Silver has. If AIC has gone from $30 to, let's say, $35 or $40, that's a 33% increase. Silver has gone from $35 to $90. That's a 157% increase. The margin expansion is objectively visible in the quarterly filings. You can go read the earnings reports yourself. These companies are printing cash. Free cash flow is at record highs. They're paying down debt. They're increasing dividends. The math is right there in black and white. Skeptic argument number 2. Jurisdictional risk. Governments will tax the profits away. This is the classic fear. You buy a miner in some developing country. Silver goes to the moon. And then the local government slaps a windfall tax on mining profits and steals all your gains. Here's the thing. This fear is exactly why the equities are so cheap. It's priced in. That's why people buy physical silver instead of mining stocks. That's why the sector has been unloved for a decade. But here's what the skeptics miss. We're not looking for a safe 5% yield. We're not buying these stocks to hold for 20 years and collect dividends. We're looking at the violent catch-up that occurs before the taxes even get drafted. Governments are slow. Bureaucracies are slow. By the time they have held the committee meetings and written the legislation and passed the new tax code, the stock will have already doubled or tripled. That's the opportunity. And here's something else nobody's talking about. Look at the short volume in Hedge mining. Ticker HL. It's at record highs. That's not risk management. That's not sophisticated hedging. That's a desperate cap. That is someone with a huge short position trying to keep the lid on this pressure cooker before it blows up in their face. So, what happens next? Tomorrow is third Friday, January 16th. Monthly options expiration. There are massive open interest positions at the $90 and $95 strike prices, billions of dollars in notional exposure. And if silver holds above those levels into the close tomorrow, a lot of institutional players are going to be in serious pain. Here's what I expect: a massive fight at those strike prices. You're going to see volatility. You're going to see whipsaws. You're going to see moves that don't make sense on the surface, but make perfect sense when you understand the options positioning. And here's what I'm watching for. If the banks start to lose control of the $90 level, expect some creative intervention, a margin hike from the comics, sudden technical difficulties on major trading platforms, a convenient news headline about Chinese demand or Indian import duties. They have tools, they have playbooks, and they will use them, because if these miners start to gap up, if the decoupling becomes obvious, if retail starts piling in, Then all those call options the bank sold go in the money, and that triggers a gamma squeeze. A multi-billion-dollar forced buying event that feeds on itself. There is no plan B for that scenario. And here's the part that bothers me. Notice how quiet the mainstream financial media is about this. Nobody's talking about the record earnings these miners are about to report next month. Nobody's mentioning the free cash flow yields. Nobody's pointing out the obvious mathematical disconnect between the commodity price and the equity valuations. This is the media blackout phase of the cycle. This is when the smart money accumulates in silence while the retail investor is distracted by whatever shiny object CNBC is waving around. So, here's my dashboard. Here's what I'm monitoring in real time tomorrow. Number 1. The silver to seal ratio. If that ratio starts to compress, meaning the miners start to move faster than silver itself, that's the signal that the decoupling has begun. Number 2, the DXY, the dollar index. If we see sudden weakness in the dollar, that's rocket fuel for commodities. It makes gold and silver more attractive to foreign buyers, and it amplifies the move. Number 3, the tick-by-tick action at the $90 level. If we hold $90 through the morning session tomorrow, if there's strong buying support every time we test that level, then I believe the suppression has failed. And if the banks lose control, if retail starts to wake up to this opportunity, if the algos flip from sell to buy, there's no second line of defense. It's over, the catch-up rally begins. Now, let me tell you my personal battle plan, and I want to be very clear. I'm not telling you what to do. I'm not giving you financial advice. I'm just telling you how I'm navigating this minefield based on 12 years of trading these markets. Here's my trigger for adding to my positions. If SIL finishes today, January 15th, flat or green, while silver stays red, I'm adding to my miner positions. That would signal to me that the decoupling is real, that the suppression is breaking, that the relative strength we saw this morning wasn't a fluke. That's a very specific, very conditional signal. It requires silver to stay weak, for the miners to show strength. That's the classic setup for a sector rotation. That's what happens right before a major move. Number 2 on my battle plan, I'm watching the 9,150 level on silver like a hawk. That's where we close this afternoon. That's the line in the sand. If we hold 9,150 through 100 p.m. tomorrow through the peak volatility window around OPEX, then I believe the floor is real. I believe the banks have lost control of the narrative. And I believe the path of least resistance is up. But here's my risk management. If silver drops below $85 tomorrow during the OPEX chaos, I'm sitting on my hands. I will not catch a falling knife. I will not try to be a hero. I will wait for the Monday morning tape to show me the true direction. Because here's the thing about options expiration days. They're designed to inflict maximum pain on maximum participants. The market makers have the playbook. They know where all the stops are. They know where the option strikes are. And they will pin the price to whichever level causes the most contracts to expire worthless. That's not conspiracy theory. That's just how the game works. So, I'm not going to fight the tape if the tape is telling me I'm wrong. My thought, I'm looking for the catch-up rally to test the 2025 highs in the mining ETF. I don't care what the talking heads say. I don't care if they call it a speculative bubble or retail mania. The math says these stocks should be trading at triple their current valuations just to reach fair value based on historical margins. And when they do catch up, if they do catch up, I'm not planning to hold for the peak. I've been in this game long enough to know that trees do grow to the sky and markets do move in straight lines. I'll take my profit when the move gets extended. When the RSI is pegged at 90, when my Twitter feed is full of people asking me if it is too late to buy, that's when it's time to sell. But we're not there yet. Not even close. Right now we're in the phase where nobody believes it, where the skeptics are loud, where the consensus is that precious metals are a boomer trade, and the real money is in AI stocks or crypto or whatever the flavor of the month is. And that's exactly where I want to be. Early positioned, patient. So, let me recap this for you in 3 sentences. Silver is at $91, but miners are stuck in the past. This disconnect is being forced by a massive options expiration tomorrow, January 16th. The math of operating leverage makes this the most undervalued sector in the entire macro landscape. The numbers don't lie, but the prices do. And tomorrow is the day the paper market meets the physical reality. Now, I want to zoom out for a second and talk about the bigger picture here. Because this isn't just about one day of volatility. This isn't just about OPEC. This is about a structural shift that has been building for years and is finally starting to crack wide open. Let me give you some historical context. During the last major precious metals bull market, I'm talking 2010-2011, we saw a similar pattern. Silver went parabolic. The miners lagged for months and then seemingly out of nowhere, they exploded higher. We're talking 200% moves in a matter of weeks. Some of the juniors went up 0%. That's not hyperbole. That's documented history. You can pull up the chart yourself. And here's the key insight. The miners always lag. They always take longer to respond than the underlying metal. The institutions are slow to reposition. The analysts are slow to upgrade. The retail investor doesn't even know these stocks exist until the move is already halfway over. But when the catch-up happens, it happens fast, violent, all at once. And that's what I'm positioning for. In December 2025, silver jumped 15%. The miners only gained 2%. The gap between the commodity and the equities widened. It became a canyon. If silver holds $90, which I believe it will, then the math says miners should be trading at triple their current valuations just to reach fair value. Not speculative value, not bubble value. Fair value based on historical margins, based on comparable multiples from previous cycles. Triple from here would put somewhere around, well, I do want to throw out specific price targets because this is not financial advice and I'm not trying to pump your bags. But you can do the math yourself. You can look at where these stocks traded in 2011 when silver hit $50, and you can extrapolate what they should be worth at $90. The math is uncomfortable because it implies the current prices are completely, utterly, absurdly wrong. And that's exactly what I believe. Now, I know some of you are thinking, if this is such an obvious opportunity, why isn't everyone talking about it? Why isn't it all over CNBC? Why aren't the big funds piling in? Great question, let me answer it. First, the narrative. Right now, the dominant narrative in finance is that precious metals are an inflation hedge and inflation is under control. The Fed is winning, the CPI is coming down, everything is fine. So, why would you own gold or silver when you could own Nvidia or Tesla or whatever the next hot AI stock is? That narrative is sticky. It takes time to shift. And by the time it shifts, by the time the mainstream catches on, the easy money has already been made. Second, the institutions are trapped. A lot of the big banks and hedge funds are short. These miners, they've been short for years. They're stuck in legacy positions that made sense when silver was at $20, but are now bleeding them dry at $90. And here's the thing about short positions. They create their own gravity. If you're short a stock and the stock starts to rip higher, you have two choices. You can cover your short and take the loss. Or you can double down, add to your short, and pray the price comes back down. Guess which one most traders choose? They double down. They fight the tape, they throw good money after bad, and they create even more explosive upside potential when they're finally forced to cover. Third, the media blackout. I mentioned this earlier, but it's worth repeating. The financial media is not your friend. They're not in the business of giving you alpha. They're in the business of selling advertising and keeping you glued to the screen. And right now, precious metals are boring. They're not sexy. They don't have a charismatic CEO doing podcasts. They don't have a Twitter army of retail traders spamming rocket emojis. So, the media ignores them until they can't anymore. Until the move is so obvious, so undeniable that they have to cover it. And by then, it's too late for the average viewer to get in at a good price. That's the game. That's how it always works. So, when I look at tomorrow, January 16th, OPEX, monthly options expiration, I'm not just seeing one day of volatility. I'm seeing the potential catalyst that breaks the dam. The moment when the suppression mechanism fails and the market has to correct these stocks based on reality instead of narrative. And here's what I'm doing tonight. I'm reviewing my positions, I'm checking my stop losses, I'm making sure I have dry powder in case we get a gift, a flash crash that takes silver down to $85 or $80 before they rip higher. Because if that happens, if I get that entry, I'm backing up the truck. I'm loading the boat, whatever cliche you want to use. I'm buying with both hands. But I'm also prepared for the alternative scenario that we just grind higher. That the $90 level holds. That the miners slowly, steadily start to close the valuation gap. That the catch-up happens over weeks instead of days. That's fine. 2, I'm patient. I've been in this trade for a long time. I can wait. But tomorrow is different. Tomorrow is the pressure release valve, and I want to see which way the steam blows. Let me tell you something else I've learned in 12 years of trading commodities. The market always teaches you humility. Just when you think you've got it figured out, just when you're feeling confident, the market will slap you across the face and remind you that you don't know anything. So I'm not sitting here tonight claiming I have perfect information or perfect foresight. I'm not saying I know exactly what's going to happen tomorrow. I'm just telling you what I see, what the data says, what the math implies. And the math implies that silver miners are grotesquely undervalued relative to the current silver price. Now, let's talk about the skeptics one more time, because I want to address every possible objection before we move on. Some people will say, but what about geopolitical risks? What about the fact that a lot of these miners operate in unstable countries? Valid point. Geopolitical risk is real. If you own a miner in Mexico or Peru or Argentina, there's always the chance that the government changes the rules, nationalizes the mine, hikes royalties, throws up new environmental regulations. That's why diversification matters. That's why you don't put all your eggs in one basket. That's why I prefer to trade the ETF, which gives me exposure to the whole sector instead of betting on one individual company. But here's the flip side. That geopolitical risk is why these stocks are cheap. That fear is priced in. So when the fear turns out to be overblown, when the mines keep operating, when the governments don't seize the assets, when the profits keep flowing, the stocks are a rate higher. That's the opportunity. And let me tell you something else about jurisdictional risk that the bears always get wrong. They treat every mining jurisdiction like it's the same. Like Mexico is the same as Peru is the same as Nevada. That's lazy analysis. The reality, some of the best performing miners in this cycle are in Tier 1 jurisdictions. Canada, United States, Australia. These aren't banana republics. These are stable, mining-friendly countries with established legal frameworks. Yes, you pay higher labor costs. Yes, the permitting takes longer. But you also get rule of law, you get property rights, you get predictability, and here's the kicker. When silver is at $91, even the hikes producers in expensive jurisdictions are printing money. The margin is so fat that it doesn't matter if you're repaying Nevada wages or British Columbia environmental standards. You're still making obscene profits. I was looking at one mid-tier producer's financials last week. Their AISC is $42, higher than average. They operate in a developed country with strict regulations. And you know what their profit margin is at $90 silver, 53% margins in a high-cost jurisdiction. So, when someone tells me they won't touch miners because of jurisdictional risk, I know they haven't actually run the numbers. They're repeating talking points from 2012 when silver was at $28 and margins were compressed. The game has changed. The math has changed. And the risks that mattered in a low-price environment don't matter nearly as much when the metal is trading at these levels. That's what the market is missing. That's what creates the opportunity. Another objection. What about declining grades? What about the fact that mines are getting deeper, ore is getting lower quality, and it's getting harder to extract silver? Again, valid concern. Declining ore grades are a real issue in the mining industry. Every year the easy stuff gets mined out, and you have to dig deeper or process lower quality rock to get the same amount of metal. But here's the thing. That's a slow-moving long-term trend. It doesn't explain why miners are priced for $30 silver when the spot price is $91. It doesn't explain the current valuation gap. Yes, over the next decade AIC will probably continue to rise, but silver will probably continue to rise faster. The macro forces driving silver higher, monetary debasement, central bank buying. Supply deficits are stronger than the headwinds facing the miners. And in the short term, over the next few months, the catch-up trade is what matters. They're re-rating the recognition that these companies are printing money at current prices. Okay, one more skeptic argument, and this is the big one. The banks will never let it happen. This is the ultimate conspiracy theory. The idea that JP Morgan or Goldman Sachs or the Fed or whoever is sitting in a dark room pulling levers, manipulating prices, and will never allow silver miners to reflect their true value. And look, I get it. I understand why people believe this. There's a long documented history of price manipulation in the precious metals markets. There have been fines. There have been whistleblowers. There have been class action lawsuits. I'm not naive. I know the game is rigged, but here's what I also know. Even rigged games have limits. Even manipulated markets eventually break, because at the end of the day, the physical market is real. Supply and demand are real. And when the paper market gets too disconnected from the physical reality, something has to give. That's what I think we're seeing right now. The paper market, the futures, the options, the ETFs, is saying silver should be suppressed. The physical market, the refiners, the mints, the vault operators are screaming shortage. And tomorrow, January 16th, we find out which one wins. So, let me bring this back to the plan. My personal game plan for the next 24 hours. Tonight, after I finish recording this, I'm going to review every position I have. I'm going to make sure my stop losses are set correctly, not too tight. I don't want to get shaken out by volatility, but not too wide. I don't want to take a catastrophic loss if I'm wrong. Tomorrow morning I'm going to be watching the tape from the opening bell. I want to see how silver opens. I want to see if the miners gap up, gap down, or open flat. If we see a repeat of this morning's action, a sharp drop at the open followed by a quick recovery, that tells me the suppression is still in play, but the floor is getting stronger. If we see silver rip higher right out of the gate, if we gap up and hold the gap, that tells me the banks have lost control and the short covering has begun. And if we see a slow grinding decline, if we break $90 and head toward 85, that tells me I need to be patient, that the trade isn't dead, but the timing is off, that I need to wait for a better entry, around 1 p.m. tomorrow. As we head into the final hours of OPEX, I'm going to be glued to the screen. That's when the real fireworks happen. That's when the market makers pin the price to maximum pain. That's when you see the wild swings and the fake-outs and the head fakes. And after the close, after the dust settles, I'm going to review the damage. I'm going to look at where we closed. I'm going to look at the volume. I'm going to look at the options, open interest that expired in the money versus out of the money. And then I'm going to make my decision for Monday because the real move, the sustainable move happens after OPEX. That's when the hedges come off. That's when the gamma is gone. That's when the underlying trend can reassert itself. If we close tomorrow above $91 on silver and silver shows relative strength, I'm adding to my positions Monday morning. I'll be early. I'll be positioned before the crowd figures it out. If we close below $85, I'm standing aside. I'll wait for the technical picture to clear up. I'll wait for confirmation that the downtrend is over. And if we close somewhere in between, in the chop zone, I'm going to do nothing, because sometimes the best trade is no trade. Sometimes the smart play is to sit on your hands and let the market show you what it wants to do. That's the discipline you need in these markets. The patience, the willingness to wait for your pitch instead of swinging at every ball. Now, let me address something I know some of you are thinking. Why should I trust you? You're just some guy on YouTube with an AI avatar. How do I know you're not full of it? Fair question. You shouldn't trust me blindly. You shouldn't trust anyone blindly. But here's what I can tell you. I've been trading these markets for 12 years. I've made money. I've lost money. I've been right. I've been wrong. I've learned the hard way over and over that the market doesn't care about your opinions or your ego or your Twitter follow account. The market only cares about price. And right now, the price is telling us something important. I built this channel because I have access to data that most retail investors don't. I have a Bloomberg terminal. I monitor vol reports. I track institutional positioning, and I got tired of watching the mainstream media miss the story or spin it in a way that benefits their advertisers instead of the viewer. So, I use this AI avatar to get the information out fast. No editing, no production delays, no waiting for some network executive to approve the script. Just the data, just the analysis, just the truth as I see it. And if I'm wrong, if tomorrow comes and silver crashes and the miners get obliterated and this whole thesis falls apart, I'll come back on this channel and tell you I was wrong. I'll show you where my analysis broke down. I'll explain what I missed. Because that's how you build trust. That's how you build credibility. Not by pretending to be infallible, but by being honest, by showing your work, by admitting when you screw up. Alright, let me tie this all together with a broader market context. Because silver miners don't exist in a vacuum. They're part of a larger macro picture. Right now, we're in a very strange environment. Equity markets are near all-time highs. The S&P is flirting with new records. Tech stocks are in the stratosphere. And at the same time, gold is over $4,000. Silver is over $90. We've got simultaneous risk-on and risk-off assets performing well. What does that tell you? It tells you that investors are hedging. They're not sure which way the wind is blowing, so they're buying everything. They're buying stocks because of FOMO, and they're buying precious metals because of fear. That's not a sustainable equilibrium. Something has to give. Either the equity markets roll over and precious metals become the safe haven trade, or the Fed successfully engineers a soft landing. Inflation stays contained and metals pull back. But here's a third scenario that nobody's talking about. What if we get both? What if equities keep grinding higher and metals keep grinding higher? What if we were entering a period of nominal gains across all asset classes because the underlying currency is being debased? That's the scenario I'm positioning for. That's the scenario where silver goes to 150, gold goes to 6,000, the stock market hits new highs, but your purchasing power stays flat because everything is getting more expensive. In that world, the miners are the ultimate asymmetric bet because they're leveraged to the metal price, but they're also equities. So they catch the bid from both sides. And that's why I'm so focused on tomorrow, because tomorrow is the day we might see the first crack in the suppression mechanism, the first sign that the dam is breaking. Let me give you one more piece of historical context and then I'll wrap this up. In 2008, during the financial crisis, silver got absolutely destroyed. It went from $20 down to $8 in a matter of months. The miners got crushed even harder. Some of them lost 90% of their value. And then in 2009 and 2010 they came roaring back. Silver went from $8 to $50. The miners went up 300, 0.00%. The point is, these markets are cyclical, they're volatile, they're not for the faint of heart. But if you can stomach the volatility, if you can stay patient, if you can wait for the setup, the rewards are enormous. Right now, I believe we're in the early innings of that kind of move. We've had the consolidation, we've had the disbelief, we've had the skepticism and the media blackout and the institutional shorting, and now we're starting to see the breakout. Tomorrow's the test. Tomorrow is the day we find out if this is real. So, here's my 3-sentence recap one more time. Silver is at $91, but miners are stuck in the past. This disconnect is being forced by a massive options expiration tomorrow, January 16th. The math of operating leverage makes this the most undervalued sector in the entire macro landscape. The numbers don't lie, but the prices do. Tomorrow is the day the paper market meets the physical reality. Things are moving fast. If you want to understand how this suppression mechanism works on the inventory side, if you want to see the vault data and the COMEX positioning, go back and watch my deep dive on the COMEX inventory squeeze. I'll be monitoring the situation in real time tomorrow. If something major breaks, if we get the move I'm expecting, I'll be back with an update. Until then, stay sharp, stay disciplined, and don't let the noise distract you from the signal. The opportunity is right in front of you. The math is clear, the setup is there. Now, we just have to see if the market agrees. Stay frosty.